Hello, everyone. In the world of Canadian tax law, there are a few concepts as crucial for business owners and their families to grasp as the tax on split income, or TOSI. These rules, they really get to the very heart of what tax fairness is all about. So, whether you're a student of taxation or a professional already in the field, getting a firm handle on TOSI is absolutely essential. Just as a preliminary note, this explainer was prepared by Samir Al-Rashani with AI support.
All right, so what's our roadmap for today? First, we're going to explore the why, the incentive for income splitting in the first place. Then, we'll lay some groundwork, covering the basic rules for property transfers and the principle of attribution. That's going to set us up perfectly to really dig into the main event, the tax on split income, TOSI itself. And we'll wrap up by looking at the key exceptions, which are just as important as the rule itself.
Okay, let's dive right in. You see, to really understand a complex rule like TOSI, you first have to understand the problem it was created to solve. And that problem starts with a really powerful financial incentive.
So why would they? The answer is really baked into the structure of Canada's progressive tax system. It's simple, really. The more money you earn, the higher your marginal tax rate goes. This creates a natural, almost gravitational pull for a high-income person to try and shift some of that income over to family members who are in much lower tax brackets. The goal? To lower the family's overall tax bill. Let's make this real with a quick case study. Imagine we have a successful owner of a private corporation. In 1 year, they earn $100,000.
Now, if that entire $100,000 is taxed just in their name, they're looking at a pretty hefty tax bill, roughly $17,000. And that's because a good chunk of that income is being taxed at those higher marginal rates.
But here's where the strategy comes in. Instead of taking that full $100,000, the owner only pays themselves $40,000. The other $60,000? That gets paid out in dividends to their 3 children who, let's say, have no other income. Now, each child's $20,000 is taxed at a very, very low rate.
And the result of this maneuver is pretty staggering. The family's total tax bill plummets from $17,000 all the way down to about $5,000. That's a $12,000 saving year after year. And this right here is precisely why the government stepped in to create rules to stop it. So, to fight this, the Canada Revenue Agency has had rules on the books for a long time about how related people transact with each other. We call these non-arm's length transactions, which is just a technical way of saying the two parties aren't independent. And these rules are really the first line of defense.
The absolute cornerstone of these rules is a concept called fair market value, or FMV. Think of it as the real-world price. It's what something would sell for on the open market. The CRA uses FMV as the benchmark to make sure family deals are legitimate for tax purposes. It stops people from just inventing prices to get a tax advantage.
These rules are really clever because they prevent any kind of tax mischief. For instance, if you sell an asset to your child for, say, $1, way less than it's worth, the CRA says, nope, for tax purposes, we're going to pretend you sold it for its full fair market value. And on the flip side, if you sell it for way more than it's worth, your child's cost is knocked back down to the fair market value. Either way, the tax result reflects reality, not some artificial price you cooked up.
Okay, so building on that foundation, we have another layer of rules. These ones are all about following the money. It's called the principle of attribution, and it's there to stop people from just, gifting an income-producing asset to a family member just so the income gets taxed at their lower rate.
So what does attribution mean? In essence, if you transfer property that earns income, like stocks that pay dividends, to certain family members, the income from that property is attributed right back to you. For tax purposes, it's like the transfer never even happened. You're still the one who has to report that income and pay the tax on it.
Now pay close attention here because there's a really critical distinction. When you transfer property to a spouse, both the income and any future capital gains from selling it are attributed back to you. But for a minor child, only the income gets attributed back. The capital gain does not. And that little no on the chart created a loophole that needed to be closed.
So, these basic rules, they were a good start, but they just weren't enough to stop the more sophisticated income-splitting strategies, especially those using private companies. And this led the government to introduce a much more direct, much more powerful tool, the tax on split income.
Let's go all the way back to our first example. Remember that $12,000 tax saving our business owner got by paying dividends to their kids? Well, TOSI was designed specifically to wipe that benefit right off the map. It ensures that income gets taxed at a high rate, no matter whose bank account it ends up in.
So, what is TOSI? Well, it's a special tax.
And when it kicks in, certain types of income, and we're talking mainly about dividends from a private company paid to a family member, are taxed at the highest personal marginal tax rate. It doesn't matter if the person who received it has zero other income. That split income gets hit with the top rate. Period.
And here's what that looks like in practice. It's dramatic. A child who would normally pay maybe a 15% federal tax rate on that $20,000 dividend is now suddenly forced to pay the top federal rate of 33%. As you can see, this just completely vaporizes the financial incentive to split income in the first place.
However, and this is a very important however, TOSI is not a blunt instrument that just applies to every single situation. The law was written with several key exceptions to allow for legitimate business arrangements to continue without being unfairly penalized.
So here are some of the big ones. For example, if the business owner is 65 or older, amounts paid to their spouse might be exempt. Income could also be exempt if it comes from what's called an excluded business or from excluded shares, or if it's simply a reasonable return on money that the family member personally invested in the business.
Let's just zoom in on one of the most practical exceptions, the excluded business rule. This is a big one. If a family member is genuinely involved in the business, and the law defines that as working an average of 20 hours or more per week, then the income they get is not considered split income. It's a very clear, bright-line test that proves they're making a meaningful contribution.
So when you put all these pieces together, fair market value, the attribution rules, and TOSI with its exceptions, you can see a single clear principle emerging. The entire system is designed to make sure that income is taxed in the hands of the person who actually earned it, whether that's through their labor, their capital, or the risk they took.
And this, class, brings us to a final, fundamental question in the study of taxation. All the rules we've just discussed are designed to draw a line in the sand between what is considered legitimate tax planning and what the government deems to be unacceptable tax avoidance. So as you move forward, I want you to think about this. Based on these complex rules, where exactly is that line? And how does it shape the business and family decisions being made all across Canada today?